Welcome to today's webinar, co-sponsored by the Bentham Center for Finance and the Julius Rabinowitz Center for Public Policy and Finance. It's my great pleasure to welcome Torsten Sløk, who's going to provide his outlook on the US economy. For many of you, he doesn't need much of an introduction, but let me still say a few words. Torsten actually studied here at Princeton and the University of Copenhagen and holds a Ph.D. in economics. He has published numerous academic research papers and worked at the IMF and the OECD before joining Deutsche Bank, where he was the chief economist for 15 years. And in his time being there, he quickly became one of the most respected and followed strategists, admired for his unique insights and in particular his ability to present key ideas in clear graphs and figures. And as a big loss to Deutsche Bank, Torsten actually joined Apollo in August 2020, just a few months ago, and continues providing his insights as the chief economist there. The timing of having him here today couldn't have been better. We are still waiting for the final election results, and we are happy to benefit from his insights in this period of uncertainty. So thanks a lot for being here, Torsten, and the floor is yours.
Thank you so much, Pallavi. Thank you so much, Moritz, for having me. And I'm literally seeing headlines come in about Nevada here. So as you say, things are still moving very quickly in terms of the outcome, but we'll have to wait and see exactly, of course, with election outcome and where it goes probably for the next few days, as we all know. But the backdrop and what I wanted to talk about today is to discuss where was the economy before the election, what are the implications of the election for where the economy might be going, most importantly, what are the implications for a fiscal expansion, which the Fed has been calling for. Both Fed Chair Jay Powell and Vice Chair Rich Clarida have been saying we need more fiscal expansion. And of course, now with the election outcome, at the moment at least, it looks like the probability of that might be lower than at least what the market and generally the consensus had expected just a few days ago. And therefore, the discussion in the chart book that I'm going to go through here is going to focus on three different things, namely the outlook for the economy more broadly, what are the implications for the Federal Reserve, and what are the implications for financial markets. The way the presentation is organized is the following. First, I will provide an overview of what are the main conclusions. Then I will discuss how did we arrive at these conclusions and what are the components and the building blocks bringing us to the conclusions in terms of the overall outlook and the investment implications at the moment. And there are three components at the moment in the macro analysis in terms of thinking about where we are and where we're going from an investing perspective. And the first one is economics. This is, of course, the question, where are we in the business cycle? Where is employment today relative to where it was pre-COVID? How many jobs have we lost? How many jobs have we recreated? How many jobs are left to recreate before we get back to the level of employment that we had in February? Then I will talk about policy. Policy, of course, is about the Federal Reserve, so monetary policy. It's about fiscal policy. And then finally, I'll have in the fourth section a discussion about market sentiment. And what is the logic with these three different sections? Well, the logic is very simple. If you are an investor, it's not enough to just talk about where are we in the business cycle. You also need to have a view on, well, what are the policy outlooks for monetary policy and fiscal policy? For example, at the moment, let's say that we are, which is exactly the case, in a situation where the economy is still relatively weak. We're not out of the hole in terms of getting to the other side of the problems because of the virus. And if there is a big fiscal expansion or not, makes a big, big difference to financial markets. So you need to combine both the economic data with your policy outlook and what both monetary policy and fiscal policy has been doing. And finally, it's not enough to only again look at economics and policy. You also need to then check in with financial markets and see if financial markets agree with you on what you think the implications are. Let's say that we had the view that the economy was getting better. Let's say we had the view that fiscal expansion might not be particularly strong. Well, if I then would say, okay, that's good for stocks, that's good for risky assets, that's good for investment grade credit and high yield and CLO and credit more broadly. Well, then a very important thing then is to test your outcome and therefore your predictions from these two building blocks with, does the market actually agree with what you're saying? In other words, does the market sentiment agree with your view that you are coming to as a result of your economic conclusions and your policy conclusions? So the logic with framing things this way here is that the most successful investors that I have met over the years are people who are able to not only look at each of these three individually, but really able to take these three different components together and make some conclusions about what are ultimately, as I have as the final thing in the presentation, the investment implications. So therefore, let me now turn first to the overview and what the conclusions are, and then we will go through afterwards how did we arrive at those conclusions by first looking at economics, then looking at the policy outlook, and then finally looking into what are the indicators for market sentiment and where things are at the moment. So with this agenda, let's first talk about the conclusions. What is the main conclusion from a very broad and macroeconomic perspective? Well, very, very simply said, the number one conclusion is that the economy is slowing. And what do we mean by slowing? Well, because of the virus, there is limited hiring in restaurants, entertainment, airline industry, across the board in close physical proximity industries. In other words, face-to-face businesses. As long as the virus is still here, it is difficult to see employment growth being strong in restaurants, to see employment growth being strong in hotels, to see employment growth being strong in retail, in healthcare, in particular, of course, parts of healthcare that have to do with elective surgeries, etc. So there are a number of industries in the economy that still are being held back because of the virus. And we'll look at some numbers in terms of how big a share of the economy is this overall. So this tells you that as long as the virus is still here, we will not be able to get employment all the way back up to where it was in February. And I'll show you some numbers with that in a minute. And that basically tells you that therefore demand for labor, if you will, in other words, the demand for people to work at restaurants and again, hotels, airlines, travel, retail, basically is going to be relatively limited as long as the virus is still a problem. So that's the number one reason why you should expect relatively weak employment growth going forward. The number two reason is that childcare and nursing home closures are also holding back hiring. And this has to do with labor supply. So the labor force participation rate more recently has actually started to go down. And one important reason for that is that if you have small children at home, or if you have parents or grandparents in nursing homes that are now also living with you because the nursing homes are closed or the childcare facilities are closed, that means that I'm not able to go and work at, say, at a restaurant, even though the restaurant might want to have me come back. But if I cannot get my children taken care of or my parents or grandparents taken care of, then my labor supply is constrained by the virus. And I'll also show you some numbers that quantifies how significant this problem is. So there's both a demand problem for labor and there's a supply problem for labor. And that's the main reason why we have already seen the labor market begin to slow down. And that's why we expect until we get a vaccine, until we get some solution to the problems with the virus, it is going to be relatively slow and sideways movement in GDP, in employment, and also ultimately in earnings, and therefore in the broader macroeconomic indicators. What are the risks to this view that the economy is slowing? And I will show you in a minute a number of pictures that confirm what I mean exactly by slowing, but what are the risks to this view that we're having a slowdown and things are no longer coming up as quickly with the V-shaped recovery that they were initially? And of course, the number one risk is a vaccine. So Dr. Fauci has said that a vaccine will be available on a widespread basis around April. So if we look at that and start thinking about when will people then get vaccinated, then a good guess is that, well, that probably means that restaurants, airlines, hotels, etc., are probably going to be somewhat subdued at least until the second quarter of next year, and maybe even all the way into the second half of next year. So of course, if a vaccine comes around and the headline starts hitting our screens potentially already in the next few weeks, that will of course be very good and promising. But before everyone is vaccinated and before people start going out to restaurants and fly around the world and do again business in the close physical proximity occupations, it is going to still take some time. Now, fiscal stimulus, as I mentioned earlier, this was from markets expected to, of course, with the potential of a blue wave, to be something that could be a dramatic game changer for the economic outlook. Now we need to wait and see exactly how big the package, and if we will get any fiscal package. I'll talk about what the size of a package should and might be and what is the need from an economic perspective. But of course, given that this is also now at least seems to be less of a probability relative to what we had before, then you might only guess today that you probably only will see this maybe even only sometime in late January, or maybe therefore also beginning to only impact the economy in the second quarter or by the middle of next year. So both these two upside risks, although it's been diminished a little bit on number two, have a timing that again suggests that we will not see any significant lift to the economy in the very near term. On the contrary, as we know very well from Germany, France, and the UK at the moment, with the risk of another lockdown and the virus coming back, there is actually some risk to the downside. And the risk to the downside, of course, is that this will also begin to have a bigger impact in a negative sense on the US economy. So that, of course, means that there's also downside risk to this view that the economy is slowing. In the worst case, and this would really be a bad scenario for the US economy, we'll begin to see the unemployment rate go up. If the unemployment rate starts going up, then the economy is no longer just slowing, then it's raising the risk that we might have a double dip, which is a W-shaped recession that, again, we're beginning to fear more, again, in the European case because of the second round of lockdowns that we're going through here. Finally, the risk of the election, of course, has more to do with whether we get a contested election or a hung election and exactly whether there's clarity about the election outcome. This is what we're going through at the moment. This risk here, at least where we sit today, is a little bit less relative to, of course, the three other risks. But the bottom line in this is that if the conclusion from the data is that the economy is slowing, well, then there are some risks to that to the upside. Some are a little bit stronger than others. And there's certainly also some risk to the downside. And what are the investment implications from this economic outlook? Well, inflation and rates will stay low for many years. The Fed is obviously very dovish. The Fed has very clearly said we're going to keep interest rates low at zero until 2023. That's a very strong statement from the Federal Reserve, clearly telling you that they do not worry about inflation. We do not worry about inflation either. We can take that debate during the Q&A if anyone is interested, but we think that the likelihood of inflation is very low when you have an unemployment rate that's 7.9, and therefore we should have a very benign environment, both on short-term interest rates and also on long-term interest rates. That means that the hunt for yield continues, meaning investors are chasing different assets out the risk spectrum. Of course, hunt for yield has been happening in investment grade credit, in high yield, in mortgages, in securitized credit cards, and auto loans have also traded very well. People also, of course, have been buying the stock market. And of course, people have also been buying more risky assets, even emerging markets, debt or credit, because the hunt for yield is very much driven by what's going on with the risk-free rate, namely short rates and long-term interest rates staying relatively low. The other implication from an investing perspective is that stock and credit selection is key given uncertainty about the virus. And what do I mean by that? Well, remember, normally from a quant perspective, the way that quantitative investors and quant models are successful is by trying to make a screen of the different things that you like in companies and things you don't like in companies. For example, normally investors like companies that have low leverage. They don't like companies that have high leverage. Normally investors like companies that have high revenue growth and not companies that have low revenue growth. And normally investors like, say, companies that have high R&D growth and not low R&D growth. And you can then, if you are a quant modeler, you can then make a screen where you pick those companies at the top of these lists and say, I'm investing in these companies because they have the right features, they are high quality companies, they're the ones that will do well historically. The problem is, in quant terminology, we now have a whole new factor that has entered my quant model. And this is either, if this is regression or principal component or factor analysis or whatever sophisticated you want to make it, if there's a whole new factor, a whole new variable that enters my equations and my statistical framework, the problem is that I don't have, over the last 10, 20 years, any variable that measures the virus, and suddenly the virus becomes the number one driver of which sectors and companies are doing well and which are not doing well. So from a very broad perspective, at the moment, it is all about stock and credit selection, picking the right stocks, picking the right companies that will do well as a function of what your view is, for how long time the virus will be here. That's why a lot of quant models and quant frameworks are struggling at the moment, simply because they're statistical models. Remember, when you run a regression, your model is only as good as the data that you put into it. And if your data does not include a pandemic situation like we have at the moment, then of course it becomes very difficult to use those 10, 20, 30 years of data for anything if you want to predict what will happen in the future. Finally, weaker growth over the coming months means more volatility in markets. If I just concluded that the economy is slowing down, that of course will mean that there's more uncertainty, in particular with these risks, some to the upside, some to the downside. And that I do realize that VIX and some measures of implied volatilities have been coming down in the last 2 days. But broadly speaking, the uncertainty about the economic outlook continues to be a very important factor when we think about what markets will be doing for the next few months. So with that conclusion, and forgive me, I spent a lot of time on this page here, but let me now show you what are the data points to back up these conclusions that I just went through. And let's first look at, as I mentioned, the economic part of this is not, you can't look at that alone, but this is nevertheless, of course, a very important backdrop for any discussion about where we are in the business cycle and what one should be doing as an investor. And one, of course, very simple way of looking at the economics of what's going on is to look at total employment in the US economy. Total employment in the US economy in February was 152 million jobs. It dropped until April to 130 million. So in other words, because of the pandemic and the shutdown in the economy and everything that came with it, we lost about 22 million jobs. Initially, we did have a V-shaped recovery. You could see that we had a very nice rebound very quickly in the first 2 months. But what is more problematic now is, as you can see, the V-shaped recovery is beginning to flatten out. We will get new numbers for this tomorrow, but where we sit today, we are, as I've written in the title, still more than 10 million jobs behind where we were in February. And the problem is, when you look at what consensus expects for employment growth tomorrow, which is around 600,000, that is not a lot when you then take into account that we're still 10 million jobs behind. That means that we're really not seeing any spectacular growth back to where we were in February. We're seeing only very, very gradual and slow growth going forward. And why is it that growth is slowing? Well, that's because of these two factors that I mentioned earlier, namely that if you look at all industries in the US economy and you try to categorize them into the somewhat unusual categorization of asking the question, how many jobs in the economy are in what the Federal Reserve calls close physical proximity occupations? So what are close physical proximity occupations? So the major occupation categories with a high proximity index are healthcare, leisure and hospitality. So that includes everything from entertaining, gaming, again, restaurants, hotels, teachers, motor vehicle operators, which again is both buses, Uber drivers, taxis, etc. And if you count the total number of workers that are in a high proximity job, meaning high close physical proximity job, that's about 27 million workers, which accounts for roughly 22% of the workforce. So if that's the case, you can quickly conclude that if the virus is still around until, say, April or maybe middle of next year, and it's going to take a while before we all go out to restaurants and go and fly and stay at hotels again, well, then the implication, of course, is that then we will not see, let me just go back to the previous page, we will not see any dramatic rebound in employment anytime soon, simply because the virus is holding back such a significant share of the economy overall. So that's the first effect, namely that there are just so many jobs that are face-to-face that it's just almost impossible to get back to the level of employment that we had in February. The other force that I mentioned is the issue of what I discussed in terms of childcare day centers being closed and nursing homes being closed. And one little bit of a backdoor way of quantifying this issue is to try to look at total employment in daycare centers and in nursing homes. So let's look at the blue line here, for example, first. This shows you what is employment in child daycare services. And as you can see, child daycare service, I have indexed that to 100 in February. Remember, this was before the virus came along. It dropped down with 35%. It was a very significant drop in daycare centers, obviously. And it's now come back. But where we are today, you can still see a lot of daycare centers are still closed. We're still roughly 20%, a little bit less in employment. So that means that there's still a lot of problems with people having their kids taken care of. And likewise, in the green line is nursing home facilities, and this is the same thing. So that's why this chart is a very simple way of essentially arguing that, well, there are some problems also with labor supply, because there's still a lot of nursing homes that are not, and also daycare centers that are not running at full capacity. And therefore, it is probably the case, as there's a lot of other anecdotal evidence of, that a lot of people can get their kids taken care of more generally. And what has the implication been of the virus more broadly for the labor market? Well, this chart here shows you employment in different parts of the economy. And here I have split the economy into two parts, namely, what is employment in jobs paying less than average hourly earnings? Remember, the average wage in the US economy is $29 an hour. So I split all the employment data into jobs that pay less than $29 an hour and jobs over here in the blue line that pay more than $29 an hour. And you can see, again, everything is indexed to 100 here in February. And you saw a significant drop in jobs, of course, for people that have lower wages. These are, of course, jobs for people at restaurants, at bars, at nightclubs, etc. Those are obviously occupations and jobs that took a very significant hit when no one went out anymore. We've seen a nice rebound, not quite back up to where we went in February, but a nice rebound, broadly speaking, in the amount of jobs in low-wage occupations. But it becomes more problematic now that you look at jobs in high-wage occupations, or people that are paid more than the average. If you look at the latest data from August to September, we've only seen that start to move sideways. So this is where we begin to worry a little bit that the pandemic begin to trickle up. Not only so there's a problem for lower paying jobs, but it's actually also beginning to become a problem for people in higher paying jobs. And you see more of the same when you look at the employment situation for people according to their education. This is again categorizing employment in February was 100. And here I have looked at in the green line, people who have a bachelor's degree or more. And the blue line is people with less than a bachelor's degree, but more than a high school diploma. And the gray line is less than a high school diploma. And have a look at what the green line did again from August to September. You actually saw that employment for people with a bachelor's degree or more actually went down. And this is, of course, the significant risk that we are worried about at the moment, namely that is there a risk that the pandemic is beginning to triple up in the income distribution, in the education distribution, and what are the implications therefore? Again, if I think about markets and I think about the chances of the unemployment rate no longer going down, but ultimately over the next few months in particular, if it gets colder and the virus takes more hold, and therefore you could begin to have a risk that is not only people in low-paying jobs that get laid off, it's actually also a problem for people in higher skill and higher experience and higher education jobs. And the main conclusion from that, of course, is that the labor market is still relatively weak, in particular in a number of sectors that still are relatively hard hit. And what I've tried to do here, and this becomes important from an individual equity and credit perspective, is to try to categorize the same logic as in the previous pages, categorize the employment developments according to different sectors in the economy. So let's just take a look here, for example, at air transportation. So this is airlines. So here what I have done is that employment in airlines in February was 100. So this is just indexed to 100 in the base month just before COVID. It dropped in April down to 85, and then actually continued dropping in August to 79, and it didn't improve in September. So if we agree that there is a chance that we might see the airline industry under some pressure, probably until we get a vaccine, then of course it becomes important to look at, well, okay, this tells you in real terms, at least in terms of employment, this is how this industry has been doing. If you take this to leisure and hospitality, which is a very broad category, so this also includes now restaurants, and of course now you can see more of a rebound. But the bottom line in this table here tells you that there are some industries that have been really hard hit. Some have had a rebound, some have not had a rebound. And at the other end of this table, of course, you have the sectors that have been doing much better. Of course, the most prime examples of that are, of course, online shopping. This is warehousing and storage. There is also a category for online shopping, which is non-store retailers. All these sectors, and also, of course, couriers and messengers, of course, which are the FedEx and UPS of the world, have, of course, also seen significant increases overall in employment. So the main conclusion is, this chart here is the quantification when people say this is a K-shaped recovery. Some parts of the economy have been doing well, other parts have not been doing particularly well. So the number one conclusion in all this is that the economic outlook is, as you can see, still relatively constrained by what's going on in the economy overall. There are some sector-specific issues that we're studying and spending a lot of time thinking hard about that are very critical. But the bottom line, as you can see, is that it is very clear that as long as the virus is here, it is very difficult to see a strong recovery, or put in very simple words. Initially, we did have a V-shaped recovery, but it looks like the V-shaped recovery is beginning to flatten out, which in very plain English is that we're moving almost into a Nike swoosh, where the Nike swoosh really is much flatter over the coming quarters until we get some resolution in the form of a vaccine, or alternatively in the form of a bigger fiscal expansion. Let me now turn to policy and what policy has done in response to the virus, and where we are in terms of, in particular, what the Federal Reserve has done, and also the prospects of what fiscal policy could do. And one chart that summarizes very well what the problem is today is that the Federal Reserve was very aggressive in buying corporate bonds. And remember, when they were buying corporate bonds, that has been very helpful for everyone who issues bonds in the corporate bond market. But buying corporate bonds is not particularly helpful for people and companies that are not active in corporate bond markets. And this is what this chart illustrates. This chart shows you the effective yield on high yield in the US. In this case, this is the Bank of America Merrill Lynch high yield corporate bond index. And as you can see, the green line, the high yield went up initially, of course, in March. We've discussed a lot what happened in March and what the problems were. The Federal Reserve came in and said, we're now buying corporate bonds. They, of course, were mainly buying investment grade credit. Then they bought fallen angels, which, as you know, are companies that normally were investment grade and were downgraded to high yield. They didn't buy high yield from the beginning, but you can see in the chart here, high yield has, of course, also seen a significant narrowing of spreads and a significant decline in the level of yields. And look at how different this is relative to the yellow and the blue line. The yellow and the blue line is the Fed's senior loan officer survey asking banks, are you tightening credit conditions on C&I loans, meaning commercial industrial loans, which is a complicated way of saying loans to corporates, in this case to large firms. And the blue line is asking, are you tightening credit conditions on loans to small firms?
So the blue line is hiding behind the yellow line here, but they show the same trend upwards. And specifically, this number shows you that at the moment, 75% of banks say, yes, we are tightening credit conditions on loans to companies. And check out the gap that there is between the green line and the other lines, the yellow and the blue line. And why is that a problem? Well, that's a problem because the green line tells you that in corporate bond markets, you can issue IG and also high yield and anything you want to if you are a big corporate. But if I'm a small coffee shop here in Brooklyn where I live and around the corner, and if they need financing, if they need cash to stay afloat while we wait for the virus to go away, they will go to the local bank. And the problem is that the local bank has tightened credit conditions very significantly in the last few quarters. This is the Fed's data that goes up to Q3. And this is highly unusual relative to what you've seen before. You could see back both in the recession in 2001 and the recession in 2008, there was a much more tight connection between what was happening in corporate bond markets and what was happening with lending conditions for banks. And that means that, very broadly speaking, remember in the US economy, half of employment in the US economy is in companies that have less than 500 workers. In other words, those companies generally don't have access to corporate bond markets. Those companies generally don't have access to credit and to issuing bonds, which is why the challenge is that as long as the banking sector is in the situation that it's in at the moment where credit conditions are as tight, that means that half of employment in the US is at risk of not getting credit and therefore not being able, if you will, to be carried across the river to get to the other side of the pandemic and therefore stay afloat. And this is, of course, a serious risk on the corporate side. And just very briefly, this is also the case when you look at the consumer side. This chart shows you also from the Fed Senior Loan Officer Survey, this is the net percentage of banks that are reducing credit limits on credit card loans. The blue line is percentage of banks increasing minimum required credit score for credit card loans. And the green line is just a composite trying to capture those things together, namely tightening credit standards on credit card loans. And you can see this basically tells you that if you would like to have a credit card today, it's a lot more difficult than what it was just, again, a few quarters ago, and in particular, of course, a few years ago. So this is also telling you that the tighter credit conditions and therefore the more difficulty in getting a loan is not only for corporates, but it's also for consumers. And finally, with monetary policy then being supportive for some parts of financial markets, namely corporate bonds, but not, at least up to this point, particularly supportive for people who want to borrow in banks, then what, of course, was done with the CARES Act was the PPP program, the Paycheck Protection Program, which is really a type of fiscal policy. And the question then becomes, well, what can fiscal policy do? And from a market's perspective, how big of a fiscal package is needed to fill up the hole in the US economy? And that's what this chart here is trying to address. So in other words, the question that this is trying to answer is, namely, how big is the fiscal need for the US economy overall? And we got data for GDP for third quarter last Thursday. And then we are now able to try to calculate how much fiscal package do we need to get back to the trend line or to fill up the hole? And the answer is, as you can see, just to get back to the trend line, we need 1.3 trillion in fiscal package. If you want to fill up the hole completely and get the unemployment rate all the way down to where it was in February at 3.5, you need a fiscal package that's 4.4 trillion, or a little bit more than 4 trillion. And why is this important? Well, this is very important because this gives us some idea about when we now begin over the next few weeks, or potentially maybe only next week, next year, to get some numbers about how much fiscal expansion is going to come. You should test this against this idea of how big is the hole in the economy and what will it take to bring us back. So if we only get a $500 billion fiscal package, whatever the composition, it tells you that that's a relatively small number compared to how big the needs are. And what's most prominent in this chart here is that the Federal Reserve has been very eager to say, we need more fiscal expansion. It is somewhat unusual that the central bank, both Lagarde and Jay Powell, have been very, very outspoken about saying we need more fiscal expansion. And the reason why they're saying that is, in my interpretation, because of this chart here telling you that there is still a relatively significant hole in the economy that needs to be filled up with more fiscal spending, because monetary policy, there are just limits, as we know too well, to what can be done. So the main conclusion is policy has done a lot on the monetary side. Unfortunately, it hasn't been helping small businesses as much as it's been helping larger businesses. And fiscal policy, it's been good. You can see that the blue line jumped up here from Q2 to Q3, but you still have a fairly significant, sizable amount of GDP, if you will, that's missing. And another way of saying that is the chart I had earlier in employment that's missing before we'll get back to anywhere near where we were in February. Let me just show you finally two other final charts, and then I'll stop and we can open for Q&A. And that, of course, has to do with market sentiment. So what is my conclusion so far? Well, the conclusion is that the economic data is beginning to move more sideways. That's a problem. And policy has done a lot in terms of monetary policy, but there's a limit to how much monetary policy can help smaller businesses because they don't have access to credit markets. The Fed has a Main Street lending facility. It's not been particularly used so far. They did some smaller tweaks to it more recently. We'll see exactly where that goes in terms of the loan size. But the bottom line still is monetary policy has not really done that much. In particular, it cannot do much going forward. And fiscal policy with the election, of course, so now is all more in turmoil how big the fiscal package will be. So that also, unfortunately, brings us a little bit back to the same conclusion that there are risks that the economic data will be slowing, again, as also exemplified by the expectation to the employment report tomorrow being relatively modest compared to how big the hole is still in employment. What does that mean for investors, and what is market sentiment then telling you at the moment with this backdrop? Well, markets are basically saying, well, this means that this is going to be a weak recovery, at least for another 4 to 6 months. And how they illustrate this is best, in my view, with this chart here, because this is the amount of debt trading at negative interest rates in the world. And have a look at where the green line has been going up, because more and more government bond prices, also corporate bond prices, have been now going negative. So now you have, in very round numbers, that $17 trillion in bonds globally are trading at negative yields. And if you look at this from a very broad perspective, this of course means that we're getting to a situation where investors need to take into account what that overall means for their asset allocation. And another chart that shows the same when we get to the investment implications is to try to categorize. And we do this calculation on an ongoing basis, and we just updated here after the election yesterday. And what this chart tells you, and this is very simple, but this is just a way of asking the question, well, how big a share of bonds globally trade at less than 2%? And if you look at this chart here, you can see that the answer to that globally is that of all bonds in the world that are outstanding, 80% are trading at less than 2%. So if you are a pension fund or insurance company or an asset manager, and you are hired to create more than 2% in returns, it's pretty obvious from this chart here, then the bond market might not be the right place to be, or at least you need to be in the parts of the bond market that potentially more risky, or at least have higher yields than the 2% you're seeing at the moment. And that's why the main conclusion, and this is the final chart I have, is that of course there's a very significant hunt for yield going on as a result of these very low rates. And we do think that this hunt for yield will continue. And this hunt for yield can simply be illustrated by this very simple risk spectrum. Here you have to the left, this is the safest asset in the world. You get overnight money from the Fed funds rate, or depending on exactly where in the world you are, the ECB, the policy rate overnight, or Bank of Japan. And that's of course a very safe asset, but the problem is that it doesn't pay you much. So you need to take some more risk. What do? Well, you start buying some duration, 10-year treasuries. The problem is that the level of 10-year rates in the US is very low, in Germany is very low, in Japan is very low. So you need to go out of the risk-free asset and begin to take some more credit risk, either in credit markets, investment grade credit, high yield bonds, it could be mortgages, it could be everything, CLOs, securitized credit cards, whatever you want to do in the spread product space, of course, could also give you some more juice relative to what you get over here. The problem is that many of these spreads have also narrowed. And that means, of course, people have been starting to buy dividend-paying stocks. They start to buy, of course, the S&P 500. And of course, ultimately, if you wanted really an extreme degree of risk, at least on this spectrum, you could, of course, buy also emerging markets, sovereign debt, or credit, or equities, or whatever your appetite for risk generally was. And for the last 10 years, in my view, financial markets have really had the same trade on everyone, namely the trade that, well, if rates are low globally, you should just go to the right and hunt risk more. And the more you went to the right, the more successful you were. So the key issue today, and let this be the final conclusion, well, what are the factors that can reverse this hunt for yield? In other words, is it just a case that you should be, asset allocation should simply just be moving more to the right in this chart here? And there are two things that you should be watching for that could reverse this ongoing hunt for yield. And those things are, number one, of course, higher inflation, because higher inflation would mean the Fed funds rate will go up. If the risk-free rate goes up, it becomes more attractive to buy the risk-free asset relative to buy the risky asset. Also, more government debt would also be associated with increase in 10-year rates, because then you begin to see a more fiscal premium coming in to long-term interest rates. That's not what we're seeing, and particularly not at the moment, given that the fiscal expansion prospects are now lower than what they were earlier. But if there is an increase in the risk-free rate in the long end, that would also begin to open some questions about what is the attractiveness of risky assets relative to the risk-free asset over here. And finally, lower dollar could potentially also play a role. And why would the lower dollar play a role in raising the risk-free rate? Because remember, foreigners own about 1/3 of US treasuries. They own about 1/3 of US IG and high yield, and foreigners own about 40% of the US stock market. So that means that foreigners are playing a very important role, and therefore how foreigners look at US policymaking, both fiscal policy and monetary policy, is absolutely critical for whether foreigners are willing to buy these assets that you have in the spectrum that I'm listing here. So that's why the number one risk to the ongoing hunt for yield is if the risk-free rate goes up for any of these three reasons. And what should you be watching of this? Of course, inflation, treasury auction metrics, the speed of dollar depreciation. If any of that happens, then you need to begin to worry about your portfolio and what the implications are for your risky assets overall. So that's why the risk-free asset, we saw a bit of that in 2018 when Jay Powell was saying rates are going up, and suddenly we hit the Fed funds rate of 2.5%. And when we got to that point, you saw significant turbulence in risky assets because people started saying, well, wait a minute, if I can get 2.5% and maybe even 3 and 4% in the risk-free asset, why should I then be invested with much more risk over here in the risky assets overall? So that's why what the risk-free rate does in finance terms is absolutely critical for any asset allocation and portfolio allocation for what's happening in risky assets overall. And the second thing that can reverse the ongoing hunt for yield is, of course, and this is really not surprising, deteriorating credit fundamentals or valuations getting so high on the stock market. And therefore, what we're talking about today is that if the speed of the recovery begins to slow down, we might have more people asking if the E and the PE ratio begins to slow down because of low growth, because of the virus still being around, because again of these industries not hiring, then you might also have more risk that people begin to say, well, the PE ratio is a little bit high given where the E is. In other words, there's an inconsistency with which cash flows are priced in to corporate bond markets and to stock markets relative to what we're actually seeing in the incoming data. So the main conclusion in this is that asset allocation for now, I do think it makes sense to hunt yield, but you got to monitor very carefully these, what I would call emerging market type problems for the risk-free rate, and generally also, of course, whether the recovery is strong or not strong enough to justify where asset valuations are. So let me end just by the page that I had in the beginning. What are the conclusions? The economy is slowing. There's some very specific virus-oriented reasons for that. The risks are, again, a vaccine, fiscal stimulus. I debated that, and we can talk more about these two specific components as upside risks. The problem is they will probably not only begin to help sometime by second quarter or middle of next year. And of course, the virus coming back in election, also a risk to the outlook. But the main conclusion still is the economy is slowing. And as I said down here, that in our view should still be helpful, if you will, and constructive on the hunt for yield with these risks that I mentioned, why the hunt for yield could be reversed. So with that, I'm so sorry, Moritz and Pallavi, I went a little bit over time, but let me stop there and start and see if there's any questions.
Yeah, no, thank you so much. I'm glad I highlighted your graphs and figures in the introduction you delivered impressively. So I'm seeing already the first Q&A question, so please continue to provide them here, and I will pass them on to Torsten. And so I just start on the top, and then Shambi asked about the role of fiscal stimulus outside of the US, and let me maybe generalize this question a bit more, like asking about how this was a lot of focus on US policy. How much should we watch global policy in these times?
Yeah, this is extremely important. As we all know, there have been some very important differences in how countries have done fiscal policy as in response to the virus. So in Europe, and most prominently in Germany, we had Kurzarbeit. And Kurzarbeit means that workers stay in their jobs. They are then paid by the government for staying in their jobs while we are waiting for the virus to go away. That's a little bit oversimplified way of talking about what exactly happened, but what generally was the case in most European countries was that there were so-called worker compensation schemes, and this was expensive. This was very significant fiscal expansion in a number of European countries, again, most prominently in Germany and France, but also most, if not all, of European countries did some versions of keeping people in their jobs. So that's why the unemployment rate in Europe, Germany, France, even Italy has not gone up that much, because people still have been staying in their jobs. This has opened up all kinds of conversations about, well, are we then keeping businesses alive that should not be kept alive? Are we keeping people in jobs that should not have been kept in jobs? I know, in my view, this gets a little bit too early to have this discussion because the shock is only still now 7-8 months old. So to say that a whole industry should have collapsed and gone out of business is a little bit of a stretch in my view. But the main answer to your good question is, therefore, there was a significant amount of money spent on keeping people in jobs. This was very different from how we did in the US. In the US, as we just discussed, the total employment loss was 22 million jobs lost. A lot of these people now were claiming unemployment benefits, which is exactly why the unemployment benefits became the main channel through fiscal policy, that it was very expensive to pay people unemployment benefits. Of course, and this of course made a lot of sense to make sure that people could keep their consumption, keep paying their bills, keep paying their rent and their mortgages. But the way that this was done and designed, and this is to this day still with the second round that we're now going through with lockdown in France and Germany and the UK, the way this is designed, the fiscal costs and the way that this was done from a fiscal policy perspective are probably going to be very significant in Europe, but in a very different way relative to how it was done in the US. That being said, the bottom line and the conclusion to the good question, Moritz, here, is that the US nevertheless still had a very significant amount of spending. So in terms of GDP, in actual spending, US still has spent more money on fiscal expansion relative to what we've seen in Europe. But that is because there was, in the US, in this case, so much spending again on unemployment benefits, also on PPP, and also on helping the Federal Reserve for any credit losses that might become associated with the facilities that they have. But broadly speaking, so far in actual spending, US still has been spending more, but in terms of commitment, the Germans are at a much, much higher level in terms of overall fiscal expansion.
And just very quickly to follow up on this, does this matter for U.S. asset prices? These global policies, and are you therefore concerned about what Japan, China, the Europe is doing?
So one thing that was very, very unusual was that the Federal Reserve, of course, stepped in and bought investment grade credit. The issue with that is that the reason why they had to do that was that so I didn't bring that chart along, but if you look at how corporates are financed in Europe and how corporates are financed in the US, you will find that in the US, the corporate sector, that the role of the banking sector overall in corporate lending is that the debt of the corporate sector, only 20% is towards the banks and 80% is toward corporate bond markets, very broadly speaking. This is the complete opposite of Europe. In Europe, the corporate sector borrowing from the banking sector makes up about 80% of corporate debt. In other words, the banking sector plays a much more significant role in Europe relative to the US. So that's why when corporates suddenly globally needed cash to stay afloat, when corporates suddenly globally had to scramble to get a lot of money to keep their business and keep their lights on and keep their businesses afloat, what had to be done in the US, because the main source of financing for corporates is corporate bond markets. Again, 80% of debt for corporates come from corporate bond markets. So the Fed really had no other choice than to support corporate bond markets to make sure that that financing was available. Whereas in the European case, corporate bond markets are only 20% of debt for corporates. So that's why in a very broad Modigliani Miller world, if you think about how companies are financed, there are some very significant differences in US relative to Europe. And that's why the implications to your question is that policy in the US was so aggressive directly in markets, which of course helped push up much, much faster corporate bond prices. And that of course was spilling over to stock prices, which is why the rebound in US equities has been more dramatic relative to what we've seen, for example, in Europe.
Great. Then a question from Julian Pinter, who suggests that it seems that financial markets don't take the possibility of a financial crisis very seriously, and whether you agree with this view, and whether what you think scenarios, for example, like student loans could be that would actually make such a scenario more likely than markets maybe at the moment think.
Yeah, so this is extremely important. And of course, one should worry a lot when you have very aggressive action by any central bank, and in particular the Federal Reserve and the ECB, and for that matter, the BOJ, start asking the question, what are the implications of this action? What does it mean that we are doing this very aggressive intervention in financial markets? One way of looking at that is then to ask, okay, if we do want to look for financial instability, then we need to look at the different players in the financial system. We need to look at the different balance sheets. And historically, one very important way of looking at this has been to look at those balance sheets that were most highly levered. In other words, those balance sheets that were most vulnerable to any significant moves in asset prices. Now asset prices have gone up very quickly. So in that sense, any vulnerabilities today are at least much less than what they were, of course, in March and April. But the bottom line is that the more levered balance sheets generally is the banking sector. And therefore, of course, also the worry now has been through this process, whether the banking sector and whether the financial system had any signs of stresses, had any signs of vulnerabilities. And broadly speaking, the answer to your question, at least the way that I look at it, is there's much less risk of a financial system crash where we are now, in some sense, mainly because of all the action done by the Fed and the ECB. And to your specific question, of course, the issue is that on student loans, on credit cards, on auto loans, on mortgages, and on consumer borrowing more generally, that's mainly driven by where the unemployment rate is. And the unemployment rate has been coming down. If it starts to go down more slowly, which is what the forecast implicit in what I was talking about here, then I would begin to worry about people potentially falling behind on their auto loans, on their credit cards, on their mortgages. And if that's the case, and also on their student loans, and if that's the case, then again, back to what the Fed has been calling for, fiscal expansion and more support, then of course we need to look out for whether there is any support or whether delinquency rates start to go up. So far, the CARES Act had some forbearance clauses that made sure that we have not seen delinquency rates and foreclosure rates go up dramatically. They've gone a little bit if you really look and you want to search for any signs of distress. But broadly speaking, at this point, I do not see any strong signs in the financial system across real money, hedge funds, the banking sector, across the board. Things are, at least today, more stable, and they're not least thanks to the significant improvements because of the Fed action in credit markets and also in stock markets.
Okay. So let me come to a number of questions on inflation outlook and rates outlook, and I start with Mike Bordeaux, who first says hi, and then talks about a book that you just read by Charles Goodhart on demographics, and that demographic forces will kind of be a big driver of, I guess, inflation, but probably also rates in going forward. And so, do you have a comment on that?
Yeah. So this is hi, Mike. Good to hear from you. I would say that the way, at least let me first answer this the way that the Fed would answer this. The Fed Phillips Curve, in very, very few words, has basically four variables: that inflation is driven by inflation expectations, which have remained relatively well contained, is driven by the unemployment rate, which, if anything, says that wage inflation and consumer price inflation should be low, is driven by the dollar. The dollar has depreciated a little bit, but this is not like emerging markets, Argentina or Turkey or other cases where you see significant crash in the exchange rate and then you see a lot of inflation. We have only seen a modest depreciation of the dollar, so I'm not overly worried about that giving much upwards pressure on inflation either. And finally, of course, comes oil prices or commodity prices, because this goes into the cost of production. And if the cost of production, you will sort of get more cost push inflation rather than demand inflation. And we haven't seen oil prices become a problem either. So at least the Phillips curve, or the Fed model of thinking, at least the Furbish way, which is the Fed's model of the US economy of thinking about inflation, would say that this is not, at least here and now, any signs of upside pressure on inflation. If anything, there's more downside pressure. Then you could say, well, the Fed's model is wrong, and maybe I should be looking at money supply, and maybe I should be looking at velocity of money. The problem is that money supply, and money supply here in very simple words, is really the Federal Reserve, again, being very aggressive, supporting credit markets and treasury markets, literally buying things and literally, in popular speak, printing money. The problem with this is that at the end of the day, that money has to go into GDP. So in monetary theory language, as we all know, it's good that the Fed is supporting credit markets and treasury markets and lifting asset prices, but that's really only creating inflation in financial assets. Ultimately, that doesn't create more inflation in the consumer price index. So that's why the conclusion for me is that if it doesn't generate ultimately transactions or GDP transactions, the actions of the Fed, and it only creates transactions in financial markets, then you should expect to see financial markets go up, but you shouldn't expect to see aggregate demand go up, because it doesn't ultimately spill over to me going and shopping more and therefore buying the CPI basket, buying an aggregate demand buying that will push inflation up higher. So therefore, at the end of this long answer to this very good question is, I still don't think from the traditional Phillips curve that there's any inflation. And I do still think that the money supply, as much as I would have loved to see that end up pushing GDP higher, I think that the nature of the way that the Fed programs just function is that it's just not able to do that. It's only able to lift asset prices and therefore create inflation in asset prices and financial markets. But unfortunately, I was about to say, not inflation in the consumer price index.
And just to understand this better, and paraphrasing some of the other questions that there are on inflation in the Q&A, I guess now at the moment it's easier to understand why there's low inflationary pressures in this pandemic, but we also had the same kind of very low inflation before, when the job market was booming, and was maybe harder to understand the inflation dynamics from this Phillips curve perspective.
Exactly.
So the answers that you're giving in terms of asset demand rather than CPI demand, that is also how you see kind of the pre-pandemic time in terms of inflation. Is that a fair summary?
I think that's a fair description. So one thing that is really, anyone today, both in the job I have now and the job I had for 15 years, when I met people and meet people who say we will have a lot of inflation, the first very, very simple way of looking at that is to say, well, have a look at where we were in February. In February, the unemployment rate was 3.5%. And we really had, despite that I had been looking at this for many years, we had actually some inflation in wages, but it was relatively limited. And in consumer prices, we really had no inflation. So that brings me to the conclusion, if the unemployment rate today is 7.9, then we are far away from 3.5 we were in February. That must mean that we are nowhere near getting the inflation, at least from a traditional sort of Keynesian perspective. I should also mention that there is another channel of inflation, which is the pandemic has, and also the trade war combined, created more worries about supply chains. You could start thinking about, so the average car has about 3,000 components. You could start thinking about, well, if a car has 3,000 components and some of these come from abroad, and there's both a trade war, and now there's also some problems because of the pandemic getting these components, wouldn't that mean that the price of a car, the price of many goods, the price of whatever ventilators, many medical devices should be going up? The problem is, if you look at the CPI basket, and if you really give a generous approach to asking the question, which components of the CPI basket are directly priced in a supply chain? In other words, which components are directly impacted by trade war, impacted by the pandemic? Then if you're really generous, you get to that number is around 10% of the CPI basket. Remember CPI, my consumption and your consumption, 40% of the basket is housing and about 20% is healthcare. So in very, very simple words, a significant share of the CPI basket is services, and only a relatively limited share, namely only around a third, a little less, about 30% is goods. So any story about supply chains and trade war and any story about the pandemic basically pushing prices up on some things that we're importing from the rest of the world that might become a little bit more expensive, those things have a relatively small weight compared to the bigger picture of services being a very, very hard hit by COVID overall.
So then let me switch to a few questions on banks and bank policy. I was struck by your picture also on this tightening of lending conditions from banks and relative to the corporate bond market. And I guess my first question was what is driving this difference, and why are banks at the moment tightening so much? Timothy Caffrey asks, states that the ECB is paying banks more to make loans to business, and I guess the natural question then is, should the Fed do something similar? Or is not doing enough? And so maybe you can clarify your views on bank tightening and policy in this.
Yeah, so this is a very hot and current topic. I mean, Lagarde last week said very clearly more is coming in December, because of course, if you have now another shutdown in Germany, another shutdown in France, another shutdown, of course, also in the UK. UK is obviously outside, not only the euro area, but outside the EU now. But the main conclusion is, if you have a weaker economy, then of course the central bank, and this is why there's discussion now, if you have less fiscal stimulus, what can the Fed do? And should the Fed be doing what the ECB has been doing and might be doing also in December? One way that the ECB has been doing this is, I know this gets a little bit into the weeds, but the TLTROs, which is a complicated way of saying the Fed and the ECB could be providing more liquidity at relatively discounted rates that would be beneficial for the banking sector in terms of getting more liquidity and parking assets essentially with the central bank for a longer period, with the goal of getting more credit to flow. And so the answer to your question is that the banking sector, of course, is in many cases globally, both US and Europe, is holding on to assets that now, of course, have been going down in value because of the pandemic. And some industries, of course, have now, of course, implicitly come to the point where the loan losses in the banking sector are at risk of going up, which is why loan loss provisioning, both in US and European banks, has been going up. So that's why, to that very good question, there's a lot that the Fed, and I'm sure the ECB, is thinking very, very hard about in terms of how can we design the right programs to make sure that we get credit to flow. And I know credit to flow sounds so arm wavy, but credit to flow is basically a way of saying, how do we make sure that the coffee shop here in Brooklyn, where I live, that they can actually stay afloat while we wait for the vaccine to come? Is it fair that they go bankrupt just because there's a virus, when bigger companies didn't go bankrupt because they can issue on markets that are heavily supported by the Fed? So that's where it becomes so complex, and particularly given the Fed's appetite for taking credit risk is so low, and that makes complete sense. It becomes so difficult to design these programs the right way. And therefore, ultimately to your question, the difference is that it's just when fiscal policy has been relatively passive for a number of reasons, both because of rules in the euro area and also in the US now because of the election outcome potentially, then there's just more and more burden on the only game in town, popularly speaking, is the ECB and the Federal Reserve, which is why, to the good question, namely, can we see the Fed do even more innovative facilities in an attempt to do and maybe replicate some of the things that are done in Europe in an attempt to make sure that corporates, not only big corporates, but small corporates also can continue to get support and again, get across the river here without going into bankruptcy and therefore going out of business.
And then related to this, so what prevents, I guess, at the moment, and this is a question from Johannes Hallermeier, this yield-seeking behavior to flow into bank funding without the ECB or the Fed providing those funds. So why are these markets so disconnected at the moment, and what kind of regulations or constraints are preventing this?
Yeah, so this is, I mean, so the hunt for yield in that chart that I mentioned with sort of just very simple arrow to the right. As we all can see, just observing our Bloomberg screens or wherever you look at financial news, it's very clear that people are chasing yields in all kinds of assets that today have spreads in fixed income language, have spreads that are incredibly tight relative to where it was in March and April, obviously. Now the question then becomes, of course, also therefore, well, but where can I then hunt yield? Obviously, one simple way of answering this is, well, then maybe you need to look at other, alternative assets, or you need to look at assets where you're locked in for a longer period. Maybe you need to hunt yield elsewhere. Some people, and this is not my view, but some people say, well, maybe I should be buying gold. Maybe I should be buying Bitcoin. I think those going up are symptoms on the hunt for yield. I would not recommend any of those two assets as investments because of a number of different reasons. But the bottom line still is, I think that everything in the financial system is exactly driven by this fact that the risk-free rate, this is really page 1 in your finance textbook. If the risk-free rate literally is 0 and is negative in Europe, negative in Japan, what do investors do? And therefore, to this specific question, that results in a hunt for yield in all kinds of asset classes, in all kinds of parts of the world, where people then have to reassess, am I satisfied and comfortable with the level of risk that I'm taking compared to the spread and the compensation that I get from a risk premium perspective. And specifically to the issue, well, why don't we get some of that money into the banking sector again? Well, some of that is ultimately also going into the banking sector that can issue IG debt, for example. But also, there's also, of course, other various ways of getting to financing and getting to returns, which is what people exactly are chasing, in particular in fixed income, but also in dividend-paying stocks. And finally, I should also mention very broadly that there's also, of course, a different way of looking at this, namely as an investor, I don't want to be part of the hunt for yield. I want to be instead in some asset classes and some investments that are not sensitive to the business cycle, that are not sensitive to COVID. And those, of course, are thematic things such as artificial intelligence, very importantly, ESG, everything that has to do with middle-income consumers in emerging markets. There's a number of themes that generally are very attractive asset classes to invest in, which are, very broadly speaking, not as sensitive to when we'll get a vaccine and as sensitive to the business cycle as directly. So that's why investors are really, on an ongoing basis, thinking very hard about how do I do asset allocation when you have some very cyclical things in the very near term. And if you have a longer horizon, then maybe there are some good arguments for looking at more thematic investment opportunities instead of just chasing the last 2 basis points in various kinds of fixed income markets.
Very good, I see. So then one of our MFin students, Christian Bjarnason, is asking a question about what you mentioned, these limits to quantitative methods that you see in times like this. And I guess the first question is kind of, is there, what does this mean in terms of a shift between quantitative fundamental investing, but also what are your suggestions of how these quantitative approaches can adjust in times like these?
Yeah, so now I want to give an answer about macro switching models, but I will say this in very simple words, that there are some different regimes that we are trading in markets at different points in time. And the challenge, of course, for all of us is to identify what are those regimes. What I tried to do here was to try to discuss what regime do I think that we are in at the moment, and what are the implications of the regime, and what are the features of that regime, and most importantly, what is the transition probability that we might switch to a different regime? What should I be looking at in terms of what could be wrong in terms of the investment recommendations that I had in here. And one very important and very simple answer to that is that, of course, if we do get a vaccine, say tomorrow, we're waiting, as I mentioned, for the headlines from Pfizer and Moderna. And as you know, there's more than 200 vaccines on the way in terms of trying to deal with the COVID problem. So at some point, it's probably a good guess that we will get a vaccine. So my best guess at the moment is that if my model that had worked for, say, the last, let's say just from an econometric perspective for the last 10 years, and suddenly I find out that as a variable I'm missing. So if I look at the data for the last 10 years, that's not helpful for me in predicting what will happen in the future. I need to then now get more and more data that includes the virus and includes the period we've been through. But now what becomes important is that, well, if the virus regime was something that only was the relationships only really worked in the period when we had the virus, and if I suddenly switch back to the regime we had before, then maybe I should be going back and trading on my quant model based on whatever it is, whatever framework you have, based on what the frameworks and the relationships were before. So I would say I'm not discouraging anyone at all. If anything, I'm encouraging everyone to study finance even more carefully, because this is exactly the challenge to figure out. And I know this sounds almost embarrassingly simple, but it does become extremely important which variables you have in your model for whether your model, and this is if it's factor analysis and everything, again, as I said, whatever, principal components versions or econometrics, or I used to have Søren Johansen as my advisor in the good old days, and he always used to say, nothing is better than your data. And he always also used to say, if you have a period and you look at high frequency daily data, it doesn't make the variation different compared to if you look at monthly or quarterly data. So you can't do any quick tricks here with getting a lot of data. You really need to think really hard about what are the variables that I'm using to predict what I think will happen in the future. And that's why the main issue at the moment, as challenging as it is in this environment, the vaccine and the virus really is, at least from a market perspective, absolutely critical in terms of figuring out whether we're going back to the old regime or staying in this regime that we're trading in at the moment.
So we have already used too much of your time. Maybe if you allow, I ask one last question that I also is on my mind, and Tiger Gao asked a similar question in the Q&A. I apologize for all the questions that I now missed in the Q&A, but I guess there's some puzzling. I was also puzzled by this. The market's going up, and Tiger Gao is puzzled by the markets going up now in this current gridlock situations, especially since the fiscal stimulus was kind of a key driver in the past weeks of financial markets. And now, as you also mentioned, it seems this fiscal stimulus seems, at least it will be smaller, it will probably be delayed. So how do we interpret at the moment this positive sentiment that we see in markets in the last 2 days?
I know this is, I mean, you could almost conclude that the market wants to go up no matter what. So I think that there's a number of things going on. The first thing, of course, that's going on is that normally when you have a period going into an election, then you have a lot of uncertainty. We've had a lot of uncertainty, of course, for the last several weeks and months about the outcome. And once you finally have some more clarity, and we'll find out soon if we have clarity or not, but we'll find out at least very soon. And it seems like that there are some scenarios that are more likely than others where we're standing today. So in that sense, it makes sense that VIX, meaning measures of implied volatility, have been coming down. Also, swaption vol, rates vol, and credit vol has also been not quite collapsing, but coming down quite substantially, because the markets now are saying, okay, now at least I know what the election outcome is. The second thing that's going on is probably also that, well, for a very long time, quant models, as I mentioned earlier, and specifically the risk parity frameworks that try to look at, on a vol-adjusted basis, what are the expected returns in different asset classes. And this issue of adjusting things for the levels of volatility and implied vol has become a much more pronounced way of investing. And the implication of that is that now that there is less fiscal expansion, then rates went down. And maybe one reason why stocks went up was simply not so much because of the election outcome, but simply because rates went down. Because people said if there's no fiscal expansion, we had almost, therefore, a mechanical result that lower rates means higher tech stocks, because they're very long duration, and therefore very long duration assets and equities generally have tended to do well. So maybe a second reason why the stock market has gone up is not so much as a vote on the election outcome as such directly, but also as an implication of the trade that many people have on, in particular in more systematic funds and more quant-driven funds overall. And the third and final thing is that, okay, if we have gridlock historically, gridlock has historically, at least when you go back in time, been a scenario where stock markets generally tend to do well. And we can debate separately why that's the case or not, but that's just the history, and this is what the data tells you. So it could also be that with gridlock, people, I mean, it was just purely second guessing here, but people might be saying, okay, now we will not have a blue wave with everything that comes with that, both fiscal expansion, but also in terms of whatever taxes, regulation, other things that markets could be thinking and chewing on in different dimensions. So I think that there's a number of different reasons why the stock market could be going up. But let me conclude by saying, I mean, as we always know, and as we always discuss all the time, that it's easy to sit afterwards and explain why stock markets have been going up, but it's of course a whole different game to then predict what they will do over the coming few days relative to what we see for the last few days. But I do think it makes sense that these three different channels could be the reasons why we've seen equities do so well.
That makes a lot of sense. Thanks a lot. And yeah, I think we're running out of time, so I think this is a great conclusion. Let me thank you so much. You have to imagine a large virtual round of applause. Thanks a lot for all your time and all your insights. Very much appreciated.
Thank you, Moritz. Thanks, Pallavi. Thank you, everyone.